I think the important thing here is a lot of people misunderstand, paying premium in the development space. Paying premium in development space does not mean that you overpay, does not mean that, you're emotionally attached to the property. The property is significantly undervalued from a developer's perspective, right? Because their market value, their notion of the market value is very different to a vendor's expectation of the market value, right? Because they are comparing it to what the face value of this property is versus a developer who's looking at the as-is complete value of what it's going to be. And that's why, this price discrepancy, fits really well in high net worth strategy perspective. Hello and welcome to Helpmebuy Property Podcast. Today we are going to talk about, does paying a premium for a property makes sense? We're going to discuss a lot of different things about why people pay premium, why does it make sense to pay premium for certain properties or certain times, or what scenarios is it okay for you to pay premium? Now, before we get into the juicy bits, let's do drum rolls and introduce Cheryl. Hello, Cheryl. How are you today?
Hello there, Moss. And this is really relevant. It's a relevant question because as we're seeing, we've got some really hot markets happening, particularly in WA. And, people are paying premium for certain things which may not stack up in value. So I think it's a really important topic to raise as to whether it does make sense or it doesn't make sense. And when, if ever, does it ever make sense to
there is a massive stigma behind this, right? That, you should never overpay for a property, right? And so I rightly believe so. But if you think about this, I would rather pay a good price for a property or a good property, an investment grade property, than pay a cheap price for a bad property. And I heard this somewhere that when you pay more, you might lose a little. But when you pay cheap and buy a dud, you potentially can lose everything. And bad doesn't mean ugly looking properties, right? Bad basically in this scenario means non-investment grade properties that a lot of people end up buying, right? Because, they're in a hot market, they buy the property, there is no competition and they think that they've got the deal of a lifetime, right? And that property grows slightly and then all of a sudden, market readjusts and people realize that, I've ended up buying something that I shouldn't have bought.
Yeah. And I guess the question is, what do you mean by good price? What's a good price? It's so relative to, so many things, right? So let's talk about what are some of the things that determine what's a premium or good price for a property. What's your definition?
Typically, when I think about the property and the price relative to the property, there is a fair price for every property that you're going to pay, right? And you're 100% right. It's a very relative term in relation to who is buying, what is their risk appetite, how much they want to spend, what have the experience been, right? And so some properties that I might buy, people might think that it's way too expensive, but others, it might be cheap for me. But then, the returns that we've got for the clients, all of a sudden people realize that, it wasn't cheap so much, right? Think about this, right? You go and take yourself back 6-7 years ago in Melbourne, say, for example, 15-20 kilometer radius, you could buy properties, under 600,000. You look back and you'd be like, wow, they were cheap, right?
Well, you look because you're looking back. Hindsight it's a beautiful thing. Because but at the time you might have said, oh my goodness, how expensive is that? I mean, it wasn't that long ago where we thought $1 million properties were expensive.
Definitely, yeah. And so the rationale that I'm quoting is that hindsight in a hot market happens a lot more quicker, right? The hindsight happens in a week's time. You realize that, you're paying an extra $10,000 every week because that's the hindsight. This is not a 6-year hindsight anymore. It's a 1-week hindsight. So, and, typically that's where the relativity comes through. And we'll talk about some of these things in quite detail because the type of the property dictates the premium nature of that property too, right? It's not always about buy and hold. I think the game changes quite significantly when you talk about development properties and paying premium for those properties. Or properties where there is location and scarcity. So, let's talk in a bit more structured manner. Why do people pay premium for a property? And there could be good and bad reasons for why people would pay premium for the properties. Let's start with the first and the most common one, which is location. And everyone talks about location. What do you think?
Well, definitely. I mean, there are certain locations or suburbs where it's going to be, there's much higher demand. So you might be, people might be paying more purely because it's in a particular catchment for a really good school, a private school or one selective school. So people are going to pay a little bit more because they want to be in that location to get access to that school. So in that sense, then you realize there's a lot more sort of emotional buying to a certain extent. And the buyers are more so, their motivation is not really so much about the property or its potential growth. It is more around what value will this property allow me, which might be access, could be access to work, could be access to schools, like we said, could be access to other things. So I think from that aspect, people are willing to pay a premium. Whether it's the right investment decision to make, that's a different thing. But I guess if from your side, when you're buying for yourself or investors for investment grade properties, when does it make sense to pay more than and I guess when I think of paying a premium, is it more than what the banks might value it? Or is it more than what the standard house in the area in comparison would be worth? That's my idea of premium.
Yeah, no, that totally makes sense. And look, I think you've hit the nail right on the head. When you talk about location, again, there is two definitions to location. Location based on personal preferences of owner-occupier, because, they have their own choice and niche of, area that they want to live in. But then, if you look at the flip side from an investment perspective, location comes down to the microeconomic factors you're talking about, the high demand, low supply areas where, the growth basically eventually translates into price growth, right? Or rental pressures eventually, translates into price growth. These are the areas where people talk about, 75 to 80% of the, property capital growth is dependent on location. Basically, this is what you mean that, if you select the right suburb, the right property, the right street at the right time, away from the busy road, of course, doing all that due diligence, you will hit the mark every time, right? And that's where the power of location, and no one can deny the power of location, right? Yeah. And that's why, one of the key things that a lot of buyers agents, including ourselves, do is, pay a lot of attention to data, pay a lot of attention to, what pockets are we going to buy in. But I was using this example for, one of my clients before, that, Perth, what it's doing right now is basically a reputation of Adelaide in 2018. And so we opened up Perth in 2020. People who have been listening to me religiously, December 2020 is when I started talking about Perth, and I said the Perth market is going to take off. And so typically when you look at Perth, when we first started in Perth, we were almost well over 50 suburbs is where our focus was. Right now, we are down to 10 suburbs only. So location, and especially chasing short-term growth, you come in and out of suburbs quite quickly, because you realize that suburb is hitting its maturity quite quickly as well. So it plays a really, really big part when it comes to, why would people pay premium? Because, location and buying in the right pocket, right location means that, you might have to pay premium when there are 30 offers on a single property in those particular locations.
Yeah. And you point out something there. It's not sort of making these decisions by chance. Like you said, if you're purchasing investment grade property, you need to have a basis and data backed information to do that. It's not sort of like, I think it's going to happen here, right? If you're going to be paying a premium, you need to be able to back that up by why you feel there is a good chance that there's going to be some level of growth.
There is a lot of herd mentality that goes into this as well, right? You see Property Profits, Property Guru, name one suburb or come out and name a few suburbs as hotspots. And then all of a sudden, you see 20 or 30 people or even 50 people, lining up and buying the property there. You have changed the suburb median quite quickly. And we're talking about smaller suburbs, right? Where 50 sales means a lot. I see that a lot that is happening in Townsville, right? Suburbs like Condon in Townsville, no one have even heard about it. Some of these areas where the population growth is so small, but, you get 50 people paying $1,000 extra, and that there is your $50,000 growth, right?
Yeah.
So,
Yeah.
eventually people don't understand that, it's not about herd mentality. It's not about following what someone is saying. It's about you doing your own research and making sure that you understand. And it's a reverse psychology as well. And I've talked about this in another podcast that I was doing the other day, where, people basically go in and buy in certain pockets and then go out and advertise that, hey, this pocket is great. And then all of a sudden people who haven't paid for these courses basically come in and start buying in those pockets. And so you would see that it's data manipulation at its best, right?
Yeah.
So again, do your research, buy based on fundamentals. Fundamentals never go wrong when it comes to property, right? Short-term growth is important. No one is denying it, but you can't fundamentally, you can't go wrong if you're buying a fundamentally right property when it comes to investment grade properties, right?
Yeah. And what example that you gave where, 50 people are putting in $1,000 or $2,000 extra, right? What is that percentage in relative to the price of the property? Because that's also another consideration. I mean, premium by how much? Are we talking premium by $100, $1,000, 10%, 20%?
See, typically, some of these pockets that I'm talking about, properties which are sub 400 properties, right? 300, 350 properties, right? So, for an extra $1,000 or $2,000 makes not a big difference, right? From a person's mindset perspective, I'm like, oh, it's an extra 2,000 or extra 5,000, right? But you see herds and herds of people coming in and doing this, that changes the median quite quickly. And for people who follow the data quite religiously, they notice these trends, right? I notice these trends on a day-to-day basis, and seeing this data coming through and be like, wow, it's so powerful, right? That, any person, and I'm not naming names here, any person who has a decent credibility and they put their hand up, even me today, right? If I put my hand up and say, hey, this is a hot suburb and I've got my clients buying there for 6 months before or a year before, and I have a following of 20,000 people, all of a sudden, even if, 10% of that following or influencing goes in and buys in that pocket, that's, me validating to my existing clients that, hey, you've seen the growth, right? And so it's such a fallacy. It's like a false economy that, is being created in the property industry that I'm seeing right now happening quite aggressively, especially in the low dominating markets, where, people are buying sub 300 properties. So
yeah, that's interesting.
And that's a good segue into land to asset ratio, right? So, and that's one of the fundamental reasons that I personally follow, where, you would pay a premium for a property when you have a good land to asset ratio. For users who don't understand land to asset ratio, let's talk a bit about that. Do the honors, Cheryl.
Sure. So you've been looking at, say, generally you might have, if you're in a suburb where you've got 400 square meter lots, but then you've got, out of a few of those properties, you might have one that's 700 square meters. And so you pick them, and the house is relatively the same size as all the others, or probably even smaller. So you've got a certain land value that is, if you break it down from a square meter rate, that it is going to cost a little bit more. And so at the end of the day, land is the part that appreciates. It's not so much the property itself and the building itself. So, yeah, you sort of have to look at then, potentially what could you do for that block. And we often will look at what is the development potential. I know that we'll address that further down, but it's looking at, could I possibly build a larger, add more rooms to this property? Could I put in a granny flat? Could I probably put a duplex on it? So there's that potential to do more with more land as well.
Definitely, 100%. And I think you're right. When you talk about land to asset ratio, the easiest way that I explain this to myself is how close to the land value are you buying this property, right? And if it's as close to the land value as possible and you're getting the house for free, then you are striking a good deal every time, because as you said, land is what appreciates. And so the easiest way to understand this basically is the same example. If the land is selling $1,000 per square meter, 400 square meter land is for $400,000. That is a going rate right now. And if you're buying a 700 square meter property, and if you're paying only say $500,000 for that particular property, the land value typically sits at around 420, or, the land value typically sits at around, almost 700,000. If you're paying 500, your land to asset ratio is well over 100%, right? Because, you're getting the house for free, right? And so I pay a lot of attention when it comes to land to asset ratio. And every time you see a land to asset ratio of over 100%, you would consider paying a bit more premium for that property, because you're just paying for the land value typically. And so adding to that, if you can add a subdivision potential to it, or you can subdivide it, or you can create an exit strategy out of it, that's a unicorn, right? Because then now you all of a sudden have that golden egg where you can unlock that equity, right? And create more for yourself. And so it's an amazing strategy. And so for people who realize this and understand that, if you can pick the right location and a good land to asset ratio and create an exit strategy together with that, you can never go wrong. And those are some of the key fundamentals that people should follow when you're talking about, paying premium for the property. Let's talk about the most interesting one, which is the potential to manufacture growth. I think this is where the game changes completely, right?
Yeah, absolutely. So I sort of found out and understood more how this sort of offering a premium works, where I became accustomed to and knowledgeable about development, but also securing properties, say via option, or where you've got a longer settlement term. And back in the good old days, what you do is that you secure a site. You might have an option for 2 years, could even have an option for 5 years. And people will pay a premium, so it might even pay 10, 15% more, sometimes even 20% more than what the value of that house currently was, to be, and with the expectation that in 2 to 5 years or whenever the option expires, that the value, that one, you could add value by putting a development approval on it, and it would increase the value of the overall property. And that's where a lot of developers would say, I will pay a premium for it. Let's just say it's hypothetically 20%, which is a big chunk, right? Usually it's 10, 15%. And owners would look at it and go, fantastic. Oh my goodness, I'm getting, if it was $1 million property, I'm getting $100,000 more just to hold it for a bit longer. Why not? And that would be sort of a real win-win for the owner, because they're holding it for another 2 years. That's fine. They get $100,000 more. And then the developer had the chance to be able to do what they wanted to do by putting a development application for, land subdivision, townhouses, whatever you might want to do, apartments or so. So that's when I first really saw the power of paying a premium. However, in the current market now, because owners are so used to getting these sorts of offers, it's not a premium anymore. It's always sort of like, I expect to get more for the property anyhow. And actually, even if I want to settle in 6 months, I want to get the same price.
Yes. And so it's become the status quo right now for a lot of development properties, because a lot of people are doing it. Owners and vendors are getting educated a lot more right now, right? So, but it's exactly right. Ultimately, when you talk about potential for manufactured growth and people paying premium for it, it's definitely through renovations or redevelopment, right? Rather than relying on the market to, deliver that growth to you. And so it's all about the profit that you can deliver through that site. And the more profit you can deliver, if you can take away your margins, then, there is enough residual price that you can pay for that particular property. I think the important thing here is a lot of people misunderstand, paying premium in the development space. Paying premium in development space does not mean that you overpay, does not mean that, you're emotionally attached to the property. The property is significantly undervalued from a developer's perspective, right? Because their market value, their notion of the market value is very different to a vendor's expectation of the market value, right? Because they are comparing it to what the face value of this property is versus a developer who's looking at the as-is complete value of what it's going to be. And that's why, this price discrepancy, fits really well in high net worth strategy perspective, where, people can make a lot of money by holding these sites through option contracts or longer settlements or buying properties with development potential that they can do more in the future as well. The biggest caveat from my perspective, for my experience and learning that has been, is that I find that while there is a lot of talk about manufactured growth and manufactured property, a lot of people do not truly understand what this means. Even like some of the most experienced buyers agents do not typically understand what this really means. So, when you talk about splitter blocks, high density zones, access with side lots, corner blocks, that doesn't mean that if a property has this, all of a sudden it becomes great. It's about having that feasibility and sticking behind that feasibility, making sure that, the numbers make sense. And of course, the numbers move sometimes too, right? There is so much ambiguity in development feasibilities. Build prices change, interest rate starts rising, and all of a sudden the sites doesn't work, or, you have put in something really, really silly, right? And, the market wants something which is a 4-bedroom, 2-bathroom, and you're building 2-bedroom townhouses there. And of course, the market is going to penalize you for doing something so silly. So it's important that, while this place is a great place to pay premium, like these properties are great to pay premium, it's also important to call it out that a lot of mistakes happens in this space too, where people actually overpay.
Absolutely, and it needs to stack up. The feasibility needs to stack up. And I say back in the day when you did a feasibility, you put an escalation price on your gross revenue. So it would be, say if we completing and selling in 3 years, in your feasibility, you put in maybe a 3% escalation every year. It's different now, where you don't put that in because the market might not move at all in that time. And if you think that it's going to escalate 3%, that should really just be a bonus on top of whatever you get. So if your feasibility doesn't work on today's dollars, don't risk it, because there'll be a whole lot of things that might happen in the next 3 years. And as we've seen, the last 2 or 3 years has been incredibly volatile in the development space. So if you are going to pay a premium, and if you are going to use something like options contracts or whichever, make sure that you've safeguarded yourself so that in case you need to pull out, that you're not going to lose the hair on your back, which hopefully you don't have anyhow. But let's not go on. Anyway, I digress.
Let's talk a bit about some of the negative sentiments around, why people would pay a premium for a property as well. And I think the first and the foremost is a lot of competition, real estate agents playing their bluff, people throwing the towel in, believing what the real estate agent is saying. So, let's talk a bit about that.
Interestingly, what are some of the tips and tricks that the agents use to convince buyers to pay a premium?
Look, I mean, in a hot market, it's so hard to call a bluff. Like me as an experienced buyer's agent as well, right? It's very, very hard to call a bluff. Sometimes they would make up stories that, I have 10 offers or 15 offers. As an experienced buyer's agent or an experienced investor, your first and foremost duty is to ask as many questions as possible, because if they are bluffing, they would contradict somewhere, right? And so it's very, very important to catch those contradictions, right? I remember, and this is a really funny story. We were buying this property for a client where we knew that, the fair price for this property was all the way up to 570. And so we would have paid 570 for this property. But, knowing me and, and trying to squeeze a deal out of an agent, we were sticking our guns to 560, 565, right? And so our final offer was sitting at 560, and we thought we'll push it to 565 and basically close the deal. And so the agent said, look, I have another offer at 565. So if you don't go above that, you're going to lose the deal. And we've done a lot of due diligence. We knew what the bank valuation was, etc. And so we didn't call on that bluff, and we said, okay, let's call this at 566 and, close the deal. And so we did. But then, later that night, I was like, what if this guy was bluffing? What if, you always have these second thoughts, right? And so this is the game that we played with the agent, right? Next morning, I called up the agent and I said, I'm sending the valuer out. We are still in the due diligence clause. There is subject to finance in there. So if the valuation doesn't stack up, I pull out. And he's like, okay, that's fine. And I divvied up a valuation, a desktop valuation of that property through a broker. And yes, this is not illegal. There is various ways you can get a valuation from the property. And I threw a valuation at him, which was $20,000 below the market, below the price that we were showing him.
Yeah.
And he looked at it and he's like, okay, let me go back to my vendor. And so he went back to his vendor, dropped the price down by 20K. And, we got that property at around, I think 540 or 545 or something. This is where the story gets really interesting. Our real valuer goes on site on Monday. And so this is Friday. And so he gets a call on Monday saying, hey, I'm the valuer for this property. I'm going to come in and visit this property. And that's where the agent realized that they have played the game better than the game that I was playing, right? And so he calls me and he said, this is not fair. You never did the valuation. Now I've reduced the price and your valuer is coming out. And I was like, no, I'm seeking another valuation. There's nothing wrong with that. I want to ensure that, the bank values it properly. And so the valuation came back fine at 445 and, there was nothing wrong with it. It would have come out fine at 450, 445. It would have come out perfectly fine at 565 as well, because we knew that the bank would value this at 572. But it's about playing this game, right? And knowing your game to that level that, you understand and realize where to squeeze, how to play in these hot markets, and understand that, there are properties where you would have 30 to 40 active buyers in any given point in time, right?
Yeah.
And so sometimes it's okay to pay an extra 5K to lock in that property now, knowing that if a week passes through, then the property price would change by $5,000 to $10,000 because that's how fast the market is moving.
Yeah. And in these situations when there is a lot of competition and it is a hot market, where do you see that you've just got to say, no, it's too much, even though it's a hot market and you see 30, 40 people, right? How much is too much?
Well, you have to identify the price point, right? So, that's very, very important that you look at the market comparables and identify what that price point is of that particular suburb, of that particular property, of that particular zone, of that particular land size, right? And you need to stick to your walkaway prices, right?
Yeah.
So you can't just be emotional about paying an extra 5K for every property, especially like for us, we buy 4 properties a week. If we start paying 5K for every property that we are going to acquire extra, we are changing the suburb median ourselves, and that just is unrealistic, right? And so it's okay to walk away from a lot of these properties where, the agents are being unrealistic, right? And so you win some, you lose some, but, you manage to basically keep the median price and don't inflate it just because, you are keen to get the customer or your client off your books and, trying to get a property for them and off they go, right? So
yeah.
There's a very thin line in how do you identify this property. And so I say do the desktop research, understand what the land value is, what the land to asset ratio is, what zone this is, what are these zones selling for, is there a development potential in there, do your due diligence, do the market comparables, identify the price point, identify the walkaway price. If you have access to bank valuation, seek a bank valuation upfront, and then go in and put your best foot forward. And if they turn around and say, no, they have a bigger offer, then just walk away. It happened to us today, like literally, we made an offer on a property for $535 as a walkaway price, and that property sold for $560. We're like, good luck, it's fine.
And I think that's like you said, you need to stay firm to what your walkaway price, because it is so easy to go, oh, it's just another $1,000. Oh, it's just another $2,000. Oh, it's another $5,000, which might add, I don't know, $100 a month to my loan. Which again, it may not seem a lot, but you just need to consider the long term. If it is in a rising market, $5,000 may not make much of a difference at all. If your intention is to hold it for a fair period as well, then that might be okay. But you need to be able to assess all the different elements of the investment grade property, what's happening in the market. So what are some other, reasons why people might pay premium for a property, but are not particularly sound reasons?
Well, I find that a lot of investors who are doing it themselves or DIY model, they get really frustrated with the process. They're looking for properties, and they get so frustrated that one, either they buy a wrong property at the right price, or they buy the right property at the wrong price. And that's just their frustration talking, right? They've missed out so many times that it's that fear of missing out that basically gets kicked in, and they basically go out there and pay a slightly higher price to basically get out of the rat race. Basically, that's the motivation.
Yeah.
And so it's important, you need to understand that patience is the key. Persistence and patience is the key when it comes to investment properties, right?
Yeah. Yeah. And that's the, like I said, the buyer fatigue. After a while, you're like, just stuff it. I'm just going to pay more to end my pain and continuous, hunt and search for the ideal property. So.
Yes. And they go into this analysis paralysis stage even post-acquisition, right? And so I remember talking to this particular person where they spent 6 months trying to find the property, ended up buying a property that was significantly overpriced. And then 6 months later, still was complaining that he's bought a property which is an overpriced property and the property is not growing in value. And like, well, why did you make that call, right? It was definitely buyer's fatigue, right? Where people are like, they throw the towel in. There's like, this is it. I can't waste my weekends. Every time on real estate and domain, my eyes hurt.
Yes. Yes.
So, yeah.
I'm going to talk to all these agents.
Yeah, and it gets really frustrating. Emotionally, it's draining as well, right? So you need to have that passion to basically, keep going back and, finding the deals, etc. So you need to be invested yourself in order to put yourself into this, into this scenario. I always say that, buying an investment property is a journey. It's not an event. A lot of people treat it as an event, and that's why they get really frustrated, right? They're like, I've been searching it for 2 weeks and I haven't found it. I should just buy anything. I have this one client this week, right? And this is a very interesting story where he has a deadline for 20th of November. He has to find and sign the property, right? And so we are like a week away from right now, right? And so I talked to him probably 3 times a day. And I said to him, and this is what I said to him, I would rather you not buy a property at all than you buy something that is silly, that is going to cause you a lot of pain.
Yeah.
Like, why? Like, just because you want to buy a property, I'll refund you your money. That's not an issue, right? But I would rather you not buy a property just because your pre-approval is expiring. I would rather you not buy the property rather than pushing yourself into buying something which is a non-investment grade property, right? So the idea is not just to buy anything. The idea is to buy the right thing so that it can take you on that journey, right?
Yeah. Yeah. And this is where that unbiased objective approach really helps, and having someone, a third party outside of yourself, where you as the buyer who isn't doing this day in, day out, that emotion can get the better of you.
I mean, there is a lot of peer pressure, right? The broker is calling you, the bank is calling you, and the wife is, saying, hey, you've been looking for the property for so long, just might as well get something. And so there is heaps of preparation. Like, people get emotionally invested into a lot of these things as well, right? If you change the equation slightly and talk about principal place of residence, right? People really, go all in when you talk about, owner occupiers, right? And so they start valuing intangible items that is important to them, but it's not important to a buyer who's going to buy a property at the end of when you're deciding to sell it, right?
Yeah.
And so why would you value and put a premium to it, right?
Absolutely.
I have this really good friend of mine who bought a house, a tiny land, which is a 4-bedroom, 4-bathroom house. And so he wanted 4 bathrooms, right?
Yeah.
And I was like, you do realize that this is not a typical owner-occupier house, right? When you decide selling it, no one would touch it because who wants to clean for toilets, every time, right? So think about some of these things, right? But people get emotionally attached to it because, that's how they feel about, property transactions. So frustration, emotional investment, this scarcity of around, I want to buy in school zones, that drives a lot of people paying premium, right? Beachside properties, waterfront properties have that Australian beach lifestyle access, they always attract a lot of premium too. Sometimes, people end up paying slightly more because they want to buy closer to the beach, or they have a water view, and, sometimes it's not water, it's maybe, not even a lake. What would you say? Like a drain or something, and it would be a water view. I was looking for one of the properties the other day and my wife is like, oh, this space is water. And I was like, no, it doesn't. It's a freaking water reserve. It's not water.
Yeah. I made the exact joke to my brother. He lives in Singapore, and if you've been to Singapore, there are some really large drains. There are actually drains, right? And his apartment overlooks a big drain. And I remember my mum saying, your brother's got water views. And like, if you won't swim in it, it's not considered water. So
like people do pay premium for it though, right?
Yeah.
I remember when I was looking for my principal place of residence, going back a long time now, I visited this property, pictures showed water. And I went there, I was like, this is a swamp, bro. Like, this is nowhere close to water. This is a swamp.
Creative right marketing there. So Ross, let's help our audience come up with a bit of a summary and a rule of thumb of what are the things to consider, and just to summarize the things that we've gone through, maybe about 3 or 4 items to go. All right, if I'm looking at this property, do I pay? Of course, we're all going to want to pay fair value for it, but at what point do I sort of allow myself to push it a little bit more? What are some good rule of thumb?
Buying as an investor, and if you're buying in areas or pockets or locations that are ripe for high demand, low supply, you're looking at the granular data, you've identified pockets that, these are ripe for, short-term growth. These pockets can move by 5 to 10K quite aggressively. Okay. So if you are ahead of the curve and so you're not following the herd, you would get an opportunity to pay the fair price. But if you are in a market where there is 10, 20, 30 offers on every property, know that it's okay to pay 5K or 10K extra for that property. Okay. I'm talking about, property worth 400 to 500. I'm not talking about $1 million property, right?
Yeah.
It's okay to pay an extra, 5% of the purchase price of the property, typically, right? Basically, did I say 5%? Yeah, 5% roughly. Yeah. And it's fine, because know this, and this is my rule of thumb, right? If there is 40 offers on a property that I want to buy and I bought this property, know this, that there are 39 people who will go out there frustrated because they've lost this property, and they will pay more, right? And so they will drive the price up, and the cycle continues, right? One person buys, there are 38 now, and they'll go out there more frustrated, and then one person buys again, and then there are 37 who goes out there and are more frustrated. So you want to be that first one who buys and gets out, right? You don't want to be the 40th one who is at the end of the curve because you are doing paralysis analysis. And a lot of investors basically end up becoming the 30th or the 35th or the 40th. And they said, oh, I bought it at the peak. Of course you bought it at the peak. You should be making and paying this decision point and way earlier in the piece, because you are following the herd mentality, right? But if you're following the data, you would be able to identify some of these pockets quite earlier in the piece, right? So that's where, it's important to understand how much it's okay to pay the premium and what dictates and decides, the premium price.
What else should we be looking at? So we talked about, and particularly we're referring to investment properties, right? Not so much, owner-occupied property. Generally, there is a little bit more emotion about it, but then we were talking about investment properties, and look at where, there's the demand and supply. We talked about development potential, and if there's development potential, how long it will take before you settle that property, making sure you do your feasibilities and that the numbers stack up on that, and that there's, you're reversing it back to what the land value is. Auctions, we haven't talked about auctions, and auctions, ones where, again, emotions run wild and there's every opportunity to pay more. What's the strategy, just to sort of tie this all up? What's the strategy to be able to manage yourself in those situations?
Auctions are the most interesting ones because, you are at your height of emotions, and that's what the auctioneer is there for, right? To drive that emotion out from you in relation to you paying for a higher price, right? The best case scenario when you go to auctions is understand what I call it is your BATNA. Your BATNA is basically your best alternative to a negotiated agreement. It's a very MBA term, and it sticks in my head all the time. So BATNA basically means that what will happen if this doesn't happen, right? What is your next best alternative, if this doesn't happen? And so, if you have other properties at similar price point, or, other deals at similar price point, would you be able to find something that is similar to this? If you can't, say, for example, this is your forever home, this has everything in it, then you would want to go a bit extra because you'd be like, well, I can't find something that has all of this in this property, right? And so if you have the means, then go for it. Don't go crazy, of course, but give yourself a walkaway price. Always give yourself a walkaway price, right? I'll share a story here. I was in an auction about 2 weeks ago, and this is very interesting. So the client was with me. This was a development site, but also their, almost like forever home that they were planning to create there. And so they were doing a duplex where, right in front of the beach, like 200 meters from the beach, you can walk to the jetty, etc., all of those things, right? And our walkaway price was 1.6 million for this property. Now, when we rocked up to the auction, there were only 3 bidders, so not a lot of activity on the auction. No one actually opened up the auction. I actually opened up the auction at that time, right? But the person that was there who felt quite agitated, I realized, because I go around speaking to people, I realized that this person is a builder, is a developer. They're there to basically do the same thing, right? Buy this property to develop. And so as the auction started, we were the 2 people that were just bidding. And so I stopped bidding. And I stopped the bidding at around 1.5. And my client who was with me, he's like, why are you not bidding? Our walkaway is 1.62, 1.64. Why are you not bidding? And I said to him, there's no point me bidding because he's a developer and a builder too. So his walkaway is exactly what my walkaway is, right? And so if I push this price all the way to 1.65, he's a builder too, he would probably go all the way up to that price point, right? An extra 510. But what it does for me is it leaves me no choice to come back into the market and request a lower price point because that's the new baseline that I've created for myself. And so if I let him have this property at 1.5, knowing that the agent already has an off market available for me that he's going to bring out in 2 weeks' time, I can actually argue my case that, hey, remember that auction? I was there and this guy bought that property at 1.5. Well, you can't ask for anything more than 1.5 for this property, right? And those are some logical decisions that you have to make when you are at the auction. Yes, you are playing the auction strategy, you're bidding against, all of that, and that's fine. You walk away. But sometimes you don't need to reach your walk away. You need to walk away from, even if you get to that walk away price at all, because you know that you need to come back to this suburb and buy more. Right?
Yeah, I really like that strategy and that forward thinking. I mean, this is premised on the fact that there's a good chance that you might find another property that's like you said, it sounds like you had some sort of information and then connections to a property that might be very, very similar. So in a sense, you've gotten rid of the competition. They're happy because they got it at a price less than what they thought they would. A little bit of short-term disappointment, but hopefully that you'll be able to secure another site at a good price. Yeah.
And so people don't foresee it that far, right? Naturally, people think in a very short term in a spur of a moment. They'll be like, oh no, this is my walkaway, so I'm going to go all in and basically, burn all the bridges and try to get this and be emotionally invested into this. So it's important that you understand what your outcome is that you're trying to achieve. How do you go around achieving those outcomes, and understand what exit strategies that you can create, and that dictates the premium price, whether you should be paying a premium for this property or not.
Yeah, alrighty. So don't just go throw money at a property. Think it through.
Definitely. And look, that's the wise words from Cheryl Leo. If you have any more questions, if you have stories, like I think we've shared so many stories today about, paying, overpaying. Why do you overpay? When would you overpay? But definitely wise words to end the conversation. If you have stories to share, if you have comments, feel free to, jump onto our podcast, share those stories, share those comments with us. Thank you for listening to us today. Take care, stay safe, keep smiling, keep investing. This is Cheryl and Moss checking out radio.
See you. Bye.